So there's a silver lining here?
Yeah, it's fun. Like, I'm not a technical analyst, but
why are you talking about the technicals then?
Because there are observations to be made here to counter some of the more bearish narratives, a narrative that I myself have pushed for quite some time. But I think the important thing to observe here is when you look historically, it is really unusual to see the S&P 500 itself get this far above the 200-day moving average, this deep into a bear market, and have it not be the end. Now, admittedly, every new market is a new spin of the roulette wheel, so to speak. But we're calling, as of yesterday's close, we're obviously a bit lower now. We're 5%, give or take, above the 200-day moving average. That would be a larger level than was realized in either the 08, the 02, the 74, those long-term multi-year secular bear markets, 69. You just don't see that historically, so it is worth observing.
How do you counter the more bearish narrative, which you cited yourself here? Eric Johnson is on in the last hour. I think he's been on this show numerous times. He's like, it doesn't matter what's happening right now. Positioning is, got so, one directional, if you want to say that. Now it's come back a bit, but it's just prolonging the inevitable. Labor market, who cares what it's doing now? It's inevitable that it's going to roll over because of what the Fed's already done.
Yeah, listen, far be it for me to push back too much on that position since I share most of it. But obviously, to be intellectually honest and look at this without rose-colored glasses in either direction, you have to observe that the landscape is better. And we can argue that sentiment is following price or price is following sentiment. That's a separate debate. But you do have the prospects of a European recession off the table thanks to the warm winter and the lower nat gas and electricity prices. You do have the prospects of China opening up and the boost that'll provide presumably to global growth, however minimal or large it might be. And then here in the U.S., any number of companies have reported. Like if you look down the list of the industrials that have reported, I find it hard to find particularly negative commentary about North America, the U.S. specifically, in the earnings reports from Honeywell, from Caterpillar, from United Rentals, which is doing quite well. When you put all that together, you can justify why the market has done what it's done without pushing back too hard on the bearish narrative.
What is it? Is the market too blind to what the Fed might still do? Sort of what Jamie Dimon was talking about today. Too soon to declare victory, could go above 5%. Stay for a while. Others have suggested they could do, several more cuts, not just the one or maybe two that the market is thinking about. How do you counter that?
Yeah, no, I wouldn't counter that. I think in general, both the equity and credit markets are discounting something resembling a soft landing and a return to a more normalized rate policy that is increasingly unlikely. I mean, I know that everyone is probably aware that CPI is next week. It's going to be 0.5 on the headline, 0.4 at the core. Both of those monthly numbers are completely unacceptable from the Fed standpoint and add fuel to the fire lit by the jobs report that the Fed's going to certainly go to 5%, perhaps even higher, and then leave them there for a long time, something that is increasingly being discounted or priced in the futures market appropriately, I would add.
What about what's been leading this year? Does that make you even more skeptical in a way?
Well, yes and no. On the one hand, we know the short basket is up 25%. We know the unprofitable tech's up 30%, far outpacing the stock market. I would also observe one of the best industries this year, as you well know, are the home builders. And the commentary from the home builders that have already reported about January activity has been meaningfully less negative than people thought. There was clear observations made. Now, granted, corporate commentary always has to be taken with a grain of salt, but there were clear observations made that the pullback in mortgage rates from 7% to 6%, let's say, spurred activity continuously over the course of the quarter. And I'm not saying that where the builders are is justified. What I am saying is one of the best performing industries, the builders, have had pretty positive commentary about one of the weakest parts of the economy, and that's the housing market.